the first thing a tariff does is it adds a cost. A tariff is a tax. Now, that tax is paid by the importer. They have the choice. Do I pass this through to my consumer, to my customer, or do I absorb some of it? Either way, either price has to go up or this margin, the profit for the importer, has to go down. So there's some cost being borne by one party or the other, or more likely a combination of the two. Now, at the end of the day, by raising the price of a foreign competitor, what you're doing is you're protecting a domestic producer. So they have the ability, seeing that maybe what had been a lower cost competition, their price has come up. Either I can take market share as a domestic producer, or I can raise my own price. I can take a little bit more margin. Usually for a domestic producer, though, I'm not getting all of my raw materials, all of my inputs from the US. I might have either components coming in from overseas, or my suppliers might have components and raw materials coming in from other countries. So I tend to see a generally higher price as well. Those are the two ways that we see inflation come through from tariffs. Beyond that, we're just adding a little bit more complexity to the supply chain. Again, that might cause a delay in decision making. Tariffs do tend to have that effect, especially today where we have so much uncertainty on what that tariff might be, how long it might be in place. Do I, as the domestic producer, really want to build a new factory here if I know that it might take more than the 4 years of a presidential term for that factory to even be built? The most important thing to remember with tariffs is that tariffs will not supersede economic fundamentals. So if a production facility didn't make sense here in the United States pre-tariffs, that 10, even 30% tariff, that might not be enough to make it economically viable versus importing from somewhere else. Now, the other important factor when I say that economic fundamentals will win out, we can see actually a good example from the 2018 round of tariffs on steel. If you look at steel prices, they responded to tariffs. We saw an immediate pop in the price of steel. But fast forward 1 year from the announcement of those tariffs after they had gone into effect, and the price for a lot of grades of steel was actually lower. That's just due to where we were in the demand cycle. Supply and demand are the two things that really determine pricing. Tariffs, that's skewing those curves, but it's not enough to completely overwrite them. Tariffs tend to suppress growth. That just naturally happens anytime you add cost. We're not finding the most efficient way to do things. If we just had purely efficient marketplaces, we would produce each good at its lowest cost of production, wherever that happens in the world. And if we just had frictionless, seamless supply chains, we'll get those goods to the market where they're best served. So that kind of highest value for each piece of production. Obviously, things aren't completely frictionless. We'll always have some natural friction, but tariffs really add to that. So what these do is it tends to, as I've said before, skew incentives. It might incentivize production at a slightly higher cost base, like say producing in the United States. That typically costs more than producing in, say, China. In recent years, we've seen a real movement away from globalism. So, nationalism is now on the upswing. General protectionism is increasing with tariffs, with other trade tensions and trade policies, but also just more broadly than trade. I think this is a unique position, especially for individuals my age who really saw throughout the 90s, let's say, especially, but it was broader than that. The shift was toward globalism. We heard about outsourcing. Now, if I think of the globalism movement as a pendulum, we swung toward globalism. Now we're swinging back toward nationalism. Tariffs are just one aspect of that movement back. Now, tariffs did really increase visibility during the first Trump administration, but we also saw President Biden put a lot of tariffs on a lot of different materials. So this isn't just a red or a blue issue. This is part of the broader political conversation we're having. And for the economic output, red or blue doesn't really matter here. It's what will be the impact pricing and otherwise of these tariffs. If our goal was to increase global GDP, the way to do that is to have resource allocation be the most efficient it could be. Tariffs decrease that because it says, I want to build up, say, my manufacturing base. I want to protect my own domestic production at the expense of someone else. In economics, you'll hear this term beggar thy neighbor with regard to tariffs. That's what we're talking about here. So, by not making things happen in the most efficient way possible, we're adding complexity to the supply chain, we're taking efficiency out of it. That naturally will cause a slightly lower level of growth. It will stimulate certain sectors. So that's not universal across the board lower growth. But if you just take the high level sum, yes, it will be suppressive. So, the easy answer to who will be more impacted by tariffs, at the end of the day, it's going to be a cost borne by the consumer, but that cost won't be evenly distributed across different sectors. So, if there is one sector, like in previous rounds of tariffs, we saw steel really be targeted. That industry bore the brunt because that tariff went up more, right? It was a higher percentage cost added. They saw the more immediate reaction. If we're just taking the assumption that tariffs are even across the board, it's going to be the goods producers, the service side of the economy will be a little bit more contained. Although even the service side, you tend to need some physical items, some goods to contribute to the service you're providing. But at the end of the day, we of the materials that we import into the United States, half of them are intermediate goods. So, producers, people who are taking different components and adding them to a finished product, they could see this increase really hurt them and hurt their margin because it's not just finished goods that will have this tariff go into effect. It's everything from raw materials to those intermediate goods to the finished goods at the end of the day. So, ITR Economics uses a four-pillar approach to forecasting. And news and current events, that's just one pillar. Now, we talk a lot about leading indicators, and I say that those tend to really be the thing to follow. But that's also just one other pillar. We want to see the interworking between things like internal trends, how that data set tends to behave. We calculate the 312, the 1212, et cetera. And our long term business cycle theory, that fourth pillar, that's the one that tends to drive these big swings in the business cycle. So any one of those pillars wouldn't stand on their own. That's why we use the comprehensive analysis. We use this full set of every possible bit of data. At some points in certain cycles, like right now, news and market observations, tariffs, for example, that tends to carry more weight. That might, in the very short term, even cause spikes, right? Cause skew to some of these data sets. But overall, the fundamentals do tend to win out. So we have to remain conscious of all four pillars together. The imposition of tariffs certainly does increase the risk of recession. Now, we at ITR Economics do not have a recession as our base case. So, while the risk might have increased, it hasn't increased enough for us to think that that is the likely outcome going forward. But as anything as politically volatile as tariffs, with the two sides so entrenched, we're getting a lot of headlines. There is a lot of noise out there around tariffs. And especially something like this, where for the business community, there are winners and there are losers. That is causing people to dig in on both sides. I think that makes the tariff issue seem a little bit more acute and maybe have a bigger impact to the economy than the data would tell us it really does. So I think emotions are running high. That's certainly true during a lot of economic cycles, but we have to look through that, look to the leading indicators, many of which are still giving us that clear signal, even if the tariff risk might cause some movement in that direction.